Hi, I'm Dan Danford. We're doing a series of podcasts for DadsDivorce.com called Money Made Easy. We take a question each week that's been posed by one of the visitors at the website, and I try to answer it as best I can. This week's question, terrific question and very timely. Which one is better, a fixed rate mortgage or an adjustable rate mortgage? Really interesting question because it depends on your circumstance which is better. Generally speaking, most people prefer a fixed rate mortgage because with a fixed rate mortgage, you know how much you're going to pay every month for the next 15 or 30 years. Okay? Most people today take out a 30-year mortgage, but with interest rates as low as they have been, many people have shifted that to a 15-year mortgage. And basically, it's kind of interesting, but the actual monthly payment on a 15-year and a 30-year mortgage aren't that different. The 15-year mortgage has a slightly lower interest rate, but the 30-year mortgage stretches the payments out for so long. It's a lower payment, but it's not that much lower between the two. So what happened is many people who took out a 30-year mortgage, say 5, 6, or 8 years ago, at some point when interest rates fell, they refinanced it with a 15-year mortgage, basically found that their payments are about the same they were paying on the 30-year mortgage. They just cut off 15 years of them. So very desirable, and people have done that historically. Now, adjustable rate mortgages kind of came into play 10 or 15 years ago, especially during the housing boom. So I'm going to say maybe they had something to do with sort of the housing boom and the credit problems that we ran into. The premise behind an adjustable rate mortgage is because the person who's loaning you the money or the bank who's loaning you the money, because they don't have to lock in an interest rate. In other words, if I'm going to loan you money for 15 or 30 years, I'm going to have to demand an interest rate high enough to make me lock up my money for that long period of time. So as I look forward, say 15 years, maybe what I say is, man, if I'm going to tie up my money for 15 years, I need to get at least 6% a year in order to make me do that. So you come to me, you want to borrow $100,000 for 15 years, I'm going to say, I won't do that unless I get 6% a year for my money. On the other hand, if you come to me and you say, hey Dan, I want to borrow 15 years worth of money, but I'll let you adjust the interest rate over that 15-year period, then I look at it and I say, well, the worst thing that could happen to me is at some point interest rates could go really high and I'm tied up with my money and I'm only getting 5 or 6% on my money, and yet I could go someplace else and make 7 or 8% on the money. So that's the worst case for me as a lender. Okay, if you've allowed me the opportunity to make adjustments if that happens, then maybe I'm going to rethink the whole thing and say, look, I'll tell you what, I'll loan you the money for 15 years and we'll start it out at only 4% a year. Now, why am I willing to do that? Because 4% is a pretty good rate today, okay? And because you've allowed me to make an adjustment later on down the road if rates go real high, okay? So here's the deal. I'm willing to give you that adjustable rate mortgage at a much lower rate than the fixed rate mortgage. The only risk for you as a borrower is that if interest rates skyrocket someplace during that 15 years, then I can go back and adjust the mortgage to a much higher rate. Now, usually an adjustable rate mortgage has a cap on it. That basically means I do get to go back and adjust the mortgage, but only to a certain level. So maybe what we say is, hey, I'll loan you the 15 years, I'll loan it to you for 4% a year. At some point in time, if rates go up, I can raise that rate to 7% a year, but not any higher than that. Okay, so then you have to sit and scratch your head and you have to decide what's a better deal for me. 4% today with a maximum potential of 7%, or would I be better off paying 6% with a fixed rate mortgage that can't change? And therein lies the dilemma. Anytime you go to borrow money for a house, they're going to give you the opportunity of borrowing money today at an adjustable rate mortgage that's considerably less than the fixed rate mortgage. Okay? That's because with the adjustable rate mortgage, the total dollars that you spend at some point could go higher. On the other hand, with the fixed rate mortgage, you're locked in and you never have to worry about the rate changing on the mortgage, although they might change the escrow payments for insurance and taxes. Generally speaking, an adjustable rate mortgage, because the rate is so much lower, will allow you to buy a larger house. So you'd be able to borrow more money with an adjustable rate mortgage than a fixed rate mortgage. The other thing to keep in mind, and you may be the exception to this rule, but it's an interesting thing to think about, is on average, the typical family stays in a home something like 5 years. So if your family is an average family, you probably aren't going to live in that house for 15 or 30 years anyway. So 4 or 5 years from now, when you get ready to trade up, which is what people do, even if you have the adjustable rate mortgage, you'll be able to lock in the rate at some different rate later on down the road, probably not a whole lot higher. Now, one more thing that's really kind of interesting is many adjustable rate mortgages come with an opportunity for you to lock in a rate later if you want to. So you might have an adjustable rate mortgage at 4%. It might have a cap on it of 7 or 8%, meaning it could never go higher than that. But it may have an annual opportunity that whatever the rate is, you can go ahead for a small fee and lock that in, and that would be the rate that you would have for the term of the mortgage. I don't know that there's a better or worse solution for people. I mean, there certainly is peace of mind that comes with the fixed rate mortgage. You never have to worry about the rate climbing for as long as you have that mortgage. On the other hand, the adjustable rate mortgage will allow you to buy more house up front, and if it's a good adjustable rate mortgage, it'll come with caps and things to protect you against the worst case scenario. Obviously, you don't have quite the protection you do with a fixed rate, but a 2% a year differential is pretty considerable. Honestly, if you save 2% less per year on your payments, I'll just do the math. You know, on a $100,000 mortgage, 4% you're going to pay $4,000 the first year, and a 6% you're going to pay $6,000 the first year. That's $2,000 over 12 months. So you can see the difference in the amount of the payment. You'll have lower payments with the adjustable rate than you will with the fixed rate. So I hope all of that didn't confuse you more. I guess the bottom line is you need to look at your circumstance and what you think interest rates are going to do in the future, and also with how tolerant you are for a changing mortgage rate. And if your tolerance is high and you don't think rates are going to go sky high in the next 5 or 7 or 10 years, then maybe doing the adjustable rate is a better thing. If you're one of those people that has trouble sleeping at night as you worry about things, then go with the fixed rate. Like all financial products, you know, there's never an easy solution, but there's probably a best solution for you and your circumstance. Hope that sheds some light on what can be a pretty complicated topic. Until next week, Dan Danford for DadsDivorce.com and Money Made Easy. Thanks.